to Basic Ranch Bookkeeping session number 3. I am Haley Shipp, and my official title here at the Ranchers Stewardship Alliance is I am the Communications and Outreach Lead. Briefly, RSA, also known as the Ranchers Stewardship Alliance, we are a rancher-founded nonprofit. We first got our wheels under us 20 years ago in Phillips County, Montana, and our home base is the community of Malta. We work off of the mission statement of ranching, conservation, communities, a winning team. And that communities piece is ever evolving. It means our immediate geographic community, but also those people who share with us a passion for keeping ranchers on the ground and giving them the tools that they need to be even more confident and successful in what they do. So just by being here tonight, you are now part of that community. We're happy to have you, and thank you for joining us. We do primarily run off of grant money. If you have an interest in what we're doing, I do encourage you to visit our website, ranchstewards.org, which Angel is dropping into our chat right now. Angel DeVries, our executive director, serving as our tech support for each of these 3 webinars. I haven't recognized her yet. 2 other ways that we're able to bring you to this event for free. Number 1, personal and or business memberships. Those details are available on our website if you feel so inspired to sign up for a membership. And then the second way that we do bring some money in that isn't a grant is with business sponsorships. So this is the first year we're actually offering that opportunity, and we wanted to thank Independence Bank, VSETH Cattle Company, AgriBest Feeds, Montana Livestock Ag Credit, Dr. Ann Johnson, DVM, Ezzy's Wholesale, Bank of Malta, First State Bank of Malta, and Hub International for jumping on. They just ran with us right away when we asked them this first year. So we're very appreciative of that. So we've had 2 of these webinars thus far. One focused on the basic functions of bookkeeping and getting started. And then the second was on that language for accountants and attorneys. Angel is dropping the link into the chat for our YouTube channel. You can go watch those again, or maybe for the first time. With that, I will be sharing, once we get this 3rd webinar up on our YouTube channel, I'll share that link again, as well as the information for PowerPoints and that sort of thing. So you can get one final email from us that's going to bundle this up into a nice little package so that you have it all together should you want to review. So as you've seen in our marketing, as well as in your workbook, this session is the last one left. It's the big picture, actionable finances and ranch profitability. It's time to get down and dirty with actually making sure we're making money. Speaking of those workbooks, if you didn't get one printed out, not the end of the world. The main thing with those is that I just wanted you to have a place to sort of gather your thoughts and your questions, because questions are going to be key as we work through this process. So Angel just dropped the long link into the chat. That's where you can actually follow along if you didn't get a workbook printed off just yet, and kind of see what we're talking about with that. And then also, some of you already have it done, but we're going to have you go ahead and turn off your cameras and your microphones. That'll help to make sure we're not bogging down the system tonight. And that can hopefully counter any sort of issues that we may have with internet. John Haskell is our speaker, and he's let us know he does have a storm going through. So if anything funky happens, that could be what's going on with that. So the main event, a point of business, as we welcome John Haskell to the webinar. He does welcome questions as he presents. So if you're listening along and something comes up, just go ahead and type your question into the chat, and I will bring that question to his attention. John has over 20 years of experience helping ranches become more profitable, starting new ranch businesses, and turning around failing ranches. He now shares his winning recipe through consulting services. While we all know ranching is hard work, knowing how to do the right work is what makes the hard work pay off. He believes time with family and friends is good for the soul. He enjoys his family time with his loving wife and 3 adorable children. They often love to get outdoors and participate in extracurricular activities. With that, John, the room is yours.
Thank you very much, Haley, and thanks to all of you who have come this evening. Haley, you have like the ultimate host voiced and presentation. I'm completely intimidated. Good job. All right. Well, with that, we will get into it. As I told Haley, we have had so much rain. I have not been able to get a haircut, which I thoroughly intended to do before tonight, and we have had enough rain at times to disrupt our internet. So for those of you that are still suffering through that, I am very sorry. We are on the flooding side of things in our community. So these things have a way of going back and forth. The first 2 presentations that you guys put on were absolutely fantastic, had a lot of really valuable information. I am going to do some things that 100% support what you've heard already, and a few things that absolutely contradict those things. And I hope we can do all that in a very friendly way. It's not to be argumentative or anything like that. My intention is to talk you guys through some tools that will help you be more successful in the management of your ranch. And of course, things that stand out to me when we talk about accounting is the idea that there are multiple different types of accounting. Tax preparation is one that many people are most familiar with. Management accounting is kind of the realm in which I work the most. And that means that we are focused on the numbers that drive the management of the business. I am very interested in profit. I absolutely love ranching, love everything about ranching, with the exception of, farming I take issue with, but that's a whole different thing. But I am a bit of a numbers guy. My wife will describe me as a complete nerd, but I don't want this to come across in any way like, numbers are the only thing we think about, or accounting is the most important part of the ranch. I enjoy situations where we work as a team with, other accountants and lawyers and nutritionists and range managers, cowboys, that sort of thing, where we sort of achieve bigger goals than just financial ones. But oftentimes we see that people are suffering the most because of financials. And so this is a place where we've chosen to work. I'm going to give a couple of quick things this by way of background. I don't want to spend too much time on this. We're going to come back to it at a few different times. But this is funny to start an accounting discussion with a discussion about mentality and psychology. But I'm just going to tell you the way we think matters, and our clients are a certain subset of people because they generally are taking responsibility for the outcomes, the financial outcomes in their business. They often are motivated by profit, at least to some degree, and know that they can be profitable in spite of weather, markets, and other things that go on outside of our control. And most importantly, when we work in this type of accounting, we have to have a fundamental belief that knowledge of our financials gives us power. That gives us the ability to influence the outcome. I hate to spend a bunch of time working on somebody's financials only to find that they have effectively a core belief that they know agriculture can't be profitable. We hear that far too often. I grew up with that paradigm and was very lucky to go to work for people who taught me otherwise. The first time I saw that, I really didn't believe it. It took me a few years to really understand the full importance of the actions that they took. And one of the most significant actions they took is they had good financials that were timely. And because they trusted the numbers and because they were timely, they became actionable. It allowed them to make changes in their business in real time that allowed them to be profitable. And the first company I went to work for had actually been profitable at the time I went to work for them for about 20 years. 1 year that I was there, I think we made about $16. It wasn't very impressive every year, but they made it a point to never be in the red. Also, the way we talk about things influences the way we think about things. We hear too many sort of negative media influences who continue to badger us with this idea that profitability is not possible or that we are not in control of our profitability. I think most of us walk around worried about things that are completely unwarranted, that are completely unnecessary, that are probably never going to happen or never going to impact our lives. And most of us walk around absolutely blind to the things that really are going to get us. So I mean that not to make you nervous, but lots of times we waste time being worried about things when the things that often harm us come out of the blue. I want to expand just a little on this "we have more power than we think" idea. And the most important one I'll use as an example is, while we don't control the market and while we don't control the weather, we have the ability to affect probabilities. And I love the example of, if I walk outside the house without a coat in January, I am probably going to be cold in Wyoming. Same in Montana. If I walk outside the house with a coat on in July, I'm probably going to be hot. I might need the coat in the morning, but by lunchtime, it's going to be fairly unpleasant. We hear a lot of talk right now about how markets are high. And while that is correct, while the market is high, that does not mean that all segments of the market are high. High markets do not drive profit. Oftentimes they can do the opposite. Low markets don't drive profit. Again, they can also do the opposite. The things that we choose to focus on are the things that are what's really going to matter. And I believe that in our ranch businesses, we often are looking at 3 to 5, let's say, enterprises. Some of them are profitable, some of them are not, and we increase our probability of being profitable by choosing those most profitable enterprises. I like to talk about our financials as a scorecard, and this is a bit of a funny graphic here, but if you go on the web and you research a chart of accounts for your ranch finances, I don't mean to pick on anybody with this. This happens to come from Texas A&M. They happen to be some of my favorite people to pick on playfully. I have lots of friends at A&M, so I don't mean anything by that. But they recommend a chart of accounts that is approximately 6 pages long, and it includes an incredible amount of detail. I am not a fan of great detail. I'm a little ADD. I'm pretty lazy. I don't like to do this sort of stuff. So if we're going to do a 6-page chart of accounts and I have to figure out where in that 6-page list every receipt that I get on a daily basis has to go, I'm going to be pretty frustrating. We focus on a set of financials that follows the good rule of dresses, which is long enough to do the job, but short enough to keep it interesting. We want to use the simplest possible financial scorecard that will give us actionable information. And I say that word actionable a lot. The most important thing is not just knowing your numbers, but in doing something about them. And the conversion from a number on a P&L or a number on a balance sheet into real life is what actually matters. And with that, a few things pop up. First of all, when we make decisions in our business, financials are not the only thing that matters. But again, as I said before, they're often a place where people struggle. So that's why we focus there. Complexity is easily the enemy of execution. That 6-page list for a chart of accounts there that I just showed you, if you can imagine trying to allocate a receipt amongst those various categories, you can see that that's going to be a lot harder the longer that list is. The other important principle is that we always begin with the end in mind. What do we want to know from our financials? And in asking that question, we want to know what the big levers are. There are many businesses, I'm going to say this a number of times, each business is unique, each context is unique. And for each of us, we have oftentimes a reasonably small number of things that will really help us get where we want to go. So we figure out what those are, and then we essentially backwards engineer our processes so that we can get to those metrics the most easily. I'll use a couple of contrasts here later, but I think of agricultural businesses in a couple of different categories, if you will. We could take a very high cash flow business such as a dairy where a check comes in every 2 weeks. We could think of a very slow turning Montana seed stock operation as an example, where it may take multiple years to get to a finished product. Those types of businesses function very differently. They have different things that are important. They have different risks and they have different opportunities. And we want to make sure we consider those when we think about financial metrics. And then I've said this a number of times, we need quality in real speed or at the speed of commerce. We have to have confidence in our numbers. And again, timeliness matters. So if I am finding out what my profitability was 16 months after the fact, I have a problem. I wouldn't drive down the highway and look out my windshield every 16 months or every 16 minutes or every 16 seconds. Probably a place I need to be looking at fairly regularly. So with that in mind, we use, I need to put the A&M one and ours in the same format, but this is essentially a summary of the chart of accounts we use. I'm not going to focus on the details of this. You'll have a recording of this. We have this posted on our website. So if you would like to see this, you can download it from us. But effectively, what we're trying to do is work in some big categories with a few subdivisions. So we have some things that give us an idea of our income. We want to know about direct costs, or those costs that change with the number of animals we run or the number of acres we farm. And then we're going to look at big picture things like administrative costs, labor costs, land costs, and this term PPE, which stands for property, plant, and equipment. So think machinery, think fuel, think repairs and maintenance, those types of things. And then we have a few other things like earned interest and co-op payments and capital expenditures and those sorts of things. We'll get back to this more, but I want you to think about this chart of accounts very functionally. So just as I said in the last slide, we begin with the end in mind. We figure out what we need to know. Most of us get in the bad habit of creating many, many accounts, and that A&M chart of accounts is a great example. Again, not to pick on anybody, but it is too easy to be a splitter in this deal. And just like overhead costs tend to creep up, I swear accounts in my chart of accounts multiply when I'm not looking. So I have got to go through and cull whatever is not providing additional value. There are times when we make our chart of accounts more complex, and there are times when we make it less complex. My personal goal is always to have it as simple, as short as possible. I always want it shorter because, again, I'm lazy. But we will add what we need to. If there's something important we have to know, then that's something we track. We'll do a few examples of some bad things that can go in your chart of accounts. I worked for a ranch once that had a series of categories that I was supposed to allocate receipts into. One of them was called miscellaneous. Not too bad. There was another one called miscellaneous other, different account, different place where things went in the financial reports. There was another one called other miscellaneous. The difference between miscellaneous, and miscellaneous other meant something to the accountants, but it meant absolutely nothing to me as a guy on the ground trying to write a code on a receipt. We often spend time with a separate category for things like postage. I have seen a number of ranches go under. I've never seen one go under because they spent too much on stamps, right? So think about these as, I want these to be like $10,000 to $100,000 plus categories, right? When we talk about labor, right, and let's say we've got a ranch with 7 employees, right? We're talking about, probably hundreds of thousands of dollars in labor and labor-related expenses. We can split that down into whether Jimmy or whether Joey are better workers. We can get into that, but in our P&L is probably not the right format. The other thing is we tend to lump all revenue from production sales, if you will. So livestock or crop sales, we lump into one line on our chart of accounts. Now, we have a lot of stuff that we have broken out details where we can look at other reports to get sort of the fine detail on that number. But the P&L is not the place to look at, are my sales coming from calves? Are they coming from lambs? Are they coming from cull cows? Are they coming from bulls? We look at that in other places. Tonight, I'm going to be pretty balance sheet and P&L focused. But I'll just tell you that we often always look at these as a suite of things, trying to balance both the economic activity, the financial activity or the cash flow, if you will, and then the maintenance, creation, and capturing, if you will, of asset value. All right, I'll take a few questions if we've got them, or stop for questions after this slide, I believe. Maybe one more. There are a few things that I'm going to do tonight. As I mentioned, if you talk to a real tax preparer, they're going to tell you that we do stuff wrong. I agree 100%. Our goal is to run the ranch. We run the ranch 365 days a year. We prepare the taxes once per year. I'll just tell you this. I don't want to be ever unfriendly with a tax preparer. Those people are a huge asset in our corner. We want them on our team. But sometimes things get a little warped kind of too far the other way. So I want to make sure that we understand that managing the business and creating a profit is the most important thing. Managing, filing, and paying taxes is a secondary thing. And there are, again, a few things that contribute to this. As I say here, markets and pastures change a lot faster than the tax code. We have seen huge changes in the tax code just in the last few years. But I guarantee you the pasture outside my office window has changed much more dramatically after 3 years of drought and then a month of 8+ inches rain in northern Wyoming. So There's a lot going on. And generally, I've kind of mentioned this deal about our focus is management, not tax. Generally, I advise people that they should pay attention to taxes at about the rate they pay. I hate to see somebody pay a 5% marginal tax rate and spend 50% of their time worrying about that. If your tax rate is low, don't spend a lot of time worrying about tax implications. If your tax rates are high, you need to spend more time worrying about tax implications. Now, there are times when our tax rate is low because we've spent time on it. That's fine. Let's just make sure we're not stepping over dollars to pick up dimes. Sometimes we get those things backwards. Okay. Again, I mentioned earlier, we have to be context specific. I can't say this enough. I get questions all the time about, well, what about? Well, yeah, every situation is unique. We have to look for things that work in our context and that are meaningful in our context. That said, there are some metrics that are more important than others. So, return on equity, return on investment, return on asset, however you want to measure that, that is a very, very important metric. We'll look at a few of these. We're going to skip over a few of these, but there are lots and lots of them. They tell us different things, and our context matters. Where we're going with our system that we're going to talk about tonight is that you need to get those numbers that are important to you so that you can get to them easily. I don't mind some 5th grade math if I need to divide one column by another column or add one number or subtract, on when I look at a P&L. I don't want this to take hours. We should be able to come up with good financial summaries from well-prepared, complete financial documents in minutes. And the other thing that is important is that we have to avoid what we call terminal uniqueness. Everybody has an excuse. We all ranch in rough country. There's a reason why where I live is not farm country. It's because you can't farm it. There are too many rocks. It's too steep. It's too dry. It's too wet. It's, whatever. In my mind, because people are profitable, it means that most of us could be profitable. There's a big difference between the average and there's even a big difference between what I do on a daily basis and what is possible. And I want to leave a lot of room for a lot bigger possibilities than what I see in front of me. Should we stop for a quick question if anybody's got one?
Sure. I'm not noticing anything just yet, but yes, okay. If you have any questions, you can go ahead and drop them in the chat, and then we can go back and forth with John here if you've got anything from what he said so far.
It's nothing like giving a talk on bookkeeping to an excited online crowd.
Well, and it's interesting on the balance sheet to have those specific examples, because like you said, there may be some things that are different from what we've heard the previous 2 sessions, and theirs were pretty much to go off of that Schedule F and use the tax criteria for it.
Correct. And that's a good point. And I heard that same thing. And I want to, let's visit about that very briefly, specifically. I don't want to make it too hard to prepare the Schedule F, but the Schedule F doesn't tell us about what our business is doing. If you look at our specific case, because we manage our taxes and we manage the growth of our business, we don't have a huge tax liability. My mortgage broker doesn't think that I have a very profitable business. That said, we have a very profitable business. So there's a wide range of possibilities between those two. In some cases, we are not profitable and we show a large tax liability. And in other places, we are very profitable and don't show a tax liability.
We've got one question here from Dale, and he's asking, what are some of the differences that we need for managerial accounting?
Good question. I think I'm going to cover that as we go. The main thing is the focus, like I say, and I believe that it's the setup of that chart of accounts that makes the biggest difference, because that is what structures your financial reports. And if you structure that chart of accounts correctly, essentially that is the way you answer questions. So that the chart of accounts is designed to answer questions. All right, let's go on. And Dale and Janet, if that's who asked that, if you don't feel like we've made progress on that question later, then ask it again. So again, the goal in my mind of managerial accounting is that action can result from it. That would be a definition in my mind. All right, so let's start with a pretty simple one. We're going to start with expenses. And I like to talk about something called a burn rate. How much money are we spending per year, per month, per day? And sometimes knowing our per day burn rate is really eye-opening. I've had this discussion with lots of people, and when I tell them, well, it costs you $30,000 a month to keep the door open, their mouth hangs open and they say, there's no way that's fun. Well, sometimes it is. All we do here for our expenses, and I'm going to give you a demo here off the P&L in just a minute. I'll talk you through it and then we'll do a demo. We just look at our total direct costs, we look at our total expenses, and we divide by 365. One thing I want to note here, this slide is here to remind me, we use things like the accounting software like QuickBooks. We use some of their definitions to suit our purposes. Direct costs and cost of goods sold technically are not the same thing. However, we are going to treat them a bit interchangeably here. Total expenses, which is a term you'll see in QuickBooks, we use the term overheads. Again, not an exact synonym in real life, but that's how we use them. We take the total, essentially everything we spend, we add it all up, we divide by 365. We recognize that that's variable based on the time of year, based on the season, that sort of thing. But having a picture of that average gives us a really good place to start. With each of the metrics we talk about tonight, I'm going to give you some targets. This is one that doesn't really have a target. It is very specific to your operation. Some of the other metrics we have real targets for. In many ways, this is relative to your income, right? If you have a $30,000 income and $100,000 in expenses, we know we have a problem with burn rate. All right, first I'm going to just show you, this is a very simplified P&L that we use. We have this license, the Oblimy Ranch data comes from the Ranching for Profit School. Many of you may be familiar with that. We have used that data because we work with a lot of their students. It makes things kind of easy. They've given us some easy examples. I've compressed this down as much as I can for this little demo, so it kind of shows what I want it to show. There are detailed numbers behind every line in this P&L, just so you know, but we're not going to look at all those right now because they're not important. So burn rate, what are we looking at? We are taking our total costs of goods sold, which in this case is $98,000, and we're adding that to our total overheads, which is $480,325.50. And we basically add them together, divide by 365. For this particular ranch, we come up with a number that is just shy of $1,600 per day. Does that make sense? Yes? All right. In the absence of questions.
Yes.
Okay, sounds good. Pretty simple. It's just an addition and then a division. So burn rate, that's what we're looking at. This will come up again. We look at debt. Debt is very important. And I'll just say generally among people in agriculture, debt aversion is a huge thing. Many of us are saddled with too much debt. We're saddled with the wrong type of debt. We are uncomfortable with debt in one way or another. Debt is something that has some very important components, long-term and short-term. For your, I can't think of her name, the FSA or the Farm Credit gal that spoke.
Lacey.
Yes, thank you. Lacey talked about short, intermediate, and long-term debt. In my world, it's either short-term or long-term. Intermediate debt is term debt, so we put it in the long-term category. You can break it out, doesn't really matter, but if we're going to do anything, there's either line of credit type debt, you pay it back in 12 months, or there is a mortgage or a cattle debt, tractor loan, pickup loan, those types of things. All right, the first big item that we look at is called working capital. Working capital is a measure of liquidity. Working capital is your ability to pay your bills month to month. I like the diagnostic that we have kind of observed over the years, which is if your working capital is bad, you're not sleeping well for 12 months of the year. You're probably fighting with your spouse. You're probably not the parent you want to be. You're probably bouncing some checks here and there. You're probably paying some late fees. You're probably uncomfortable when you go in to renew your line of credit. Working capital, and Lacey talked about current ratio or quick ratio. We use working capital. It uses the same inputs as the current ratio, but we do it in subtraction, and we try to keep everything in dollars and days. What we do is we take our current assets and we subtract our current liabilities. In our current liabilities, we include the current principal portion of our long-term debt. So if I have a mortgage that has a $50,000 principal balance and my annual payment is $10,000, principal plus interest, I will separate off the principal portion. So let's say that's $7,000, and I will add that to my short-term debt. All I'm trying to do is how much cash am I going to have to come up with in the next 12 months or before the 31st of December. And after we have done that subtraction, then we just divide. So we get a dollar figure, right? We subtract assets in dollars or liabilities in dollars from assets in dollars. And then we divide by our burn rate. And that gives us a number of days. Let me come back to that in just a second. So if we look at a balance sheet, this is again a very compressed balance sheet. We have current assets. We don't actually have any, here, fixed assets, long-term assets. This would be another type of long-term asset. And then we have current liabilities and long-term liabilities. Lacey did a great job of explaining current and long-term. Think of it as either 12 months or longer than 12 months.
So we do have a question here.
We just do a simple subtract on this. Yes.
They want to know, would you include your yearly operating loan in current liabilities for the working capital calculation?
Yes, absolutely. Generally, our line of credit is the central portion of that. So yeah, that's exactly right. Your operating loan is considered a short-term obligation. Is that clear?
Yep.
Good. And then current assets, let's talk about what's in that category. Lacey went through that the other night and did a very nice job. But current assets includes feed, stocker cattle, cash, receivables. You know, if you've shipped some cows but haven't gotten the check yet, that kind of IOU all goes into that category. Things that are not included in current assets are cows, right? They are a long-term asset. They'd be an intermediate in the language of farm credit. Trucks are not short-term assets. Mortgages are not, land is not a short-term asset. And essentially all of those things and the debt associated with them is what we call current or short-term assets. All right. So in this case, you can see we've got two, because I did 2 years side by side, we have two opportunities. I tried to add colors on this. I don't know if this makes this more easy to read or less. All I wanted to do here is I've got a little table where I actually did the subtraction. So the color goes with what it is. So the orange is our current assets. So for 22, in this example, we had $594,000 worth of current assets. And we had $372,000 worth of current liabilities, left us with a working capital of $222,000. Now, the question you ask is that number good or is it bad? Well, we need to scale it a little bit. That means we need to put it in progression. $22,000, $30,000 a month doesn't leave much for breathing room. On this example, we used a daily burn rate of $1,500 or almost $1,600 a day, which in 2022 left us with 140 days of working capital. And in 2021 left us with a negative 22 days of working capital. Most of the time, if I walk into your house and your neighbor's house and you have negative $22 worth of working capital, and or negative 22 days of working capital, and your neighbor has 140 days, I can tell the difference without ever seeing your financials. You talk to your family differently when your working capital is bad like this. This literally is you are behind in your ability to pay the bills. Right? We all sweat when that happens. We use, I'm going to come back. I think this is the same slide again. Calculation, I hope, is fairly clear, We're going to come back to this. I think I talked about all this. Yeah. So we have a target of about 120 to 150 days. So think 3 to 5 months, if you will, in total range of a working capital target. We would like 25% of your working capital in cash, not in a line of credit. Why is that an advantage? Would anybody like to try to answer that?
See if there's any brave souls here.
Okay, I'll go ahead. Please chip into the chat if you think you got an answer on this. Less interest. That's a good guess. That can be. Sometimes, though, I will advocate that people preserve some of their own cash, even if it means they have to take a little more out on their line of credit. So sometimes it works the opposite. Working capital is like freeboard on a boat. Okay, working capital gives you ability to absorb shocks to the system. I don't know about the rest of you, but where I run cows, it's a little variable. Sometimes bad things happen. Sometimes calves get sick. Sometimes it snows on Halloween and the snow doesn't leave until the middle of May. Sometimes the market doesn't behave the way I think. Peterson Ranch, freedom and ability to take advantage of opportunities. That's exactly what we're going for. In the chat, that was a comment there, if that's not clear to everybody. Yes, if I have cash in hand and a great opportunity presents itself or a minor disaster presents itself, I have the ability to take action without having to go and talk to anybody else. And I mean nothing against bankers. I'm great friends with my banker and a number of others. It adds gum in the works if I have to go talk to them before I'm going to go make a decision. Transmission on my pickup went out a couple of months ago. Good working capital means that I just go fix it. It doesn't really cause us a problem. Sets us back a little bit, makes life a little uncomfortable, but we didn't have to put it on, the family credit card, for example, to service the ranch pickup. Yes, the Peterson Ranch, whoever that is there, that this freedom component is very important. Flexibility is very, very important. Resistance or resilience, if you want to talk about it that way, makes sense. So I hear people talk about pasture management, leaving residual and all that. And oftentimes the people that do that don't leave any residual in their checking account. If I have a little extra hay in the stack at the end of the winter, I am more comfortable than if I'm down to my last 5 bales and it's, the 30th of March. All right, let's go on. We are going to talk next about debt coverage. This is another one that people really struggle with. I want to try to make this as easy as possible because debt coverage is a fantastically easy topic in real life. It comes with a tremendous amount of emotional baggage. That's a whole different thing. The math around it is easy and can give us some real reassurance. The debt coverage ratio, we simply divide and I'll show you where I'm getting all of these numbers here before we move on. We divide our net operating income, which is all of our income minus all of our expenses, more or less. And we divide that by our debt payments. And the debt payment here is the principal and interest portion. So it's the actual amount you write the check for. This is literally a number that asks, do we have enough profit at the end of the year to pay our debts? Debt technically is an after-tax payment. We have to remember that. So it comes out of your operation after you have paid taxes. So if you owe $100,000 as a payment on a mortgage, for example, you always pay that with after-tax dollars, which means you need to have a little padding, because if you have the $100,000 to make the $100,000 debt payment, you're probably also paying some taxes. Not always, but often. We also want to accommodate risk. So we have a target debt coverage ratio that is between, let's say, 1.5 and 2 on the bottom side. You can go as high as you want with this. If you want a debt coverage ratio of 70, it doesn't hurt me any. That may not be the best business choice, but if that's where you're comfortable, that's great. But if you go below 1.5 in any particular year, you are exposing yourself to a great deal of risk. You are literally risking that you do not have enough money to make the payments. Now, I want to emphasize again, this is long-term debt payment. We look at working capital, which is all about short-term debt, and debt coverage, which is all about long-term debt. We look at those two things independently, and then ultimately we wind up looking at them together, right? But we want to make sure we've broken them apart. If you are acquiring new assets and taking on new debt in the process, I am okay if you back your debt coverage ratio down to 1.5, if there is the underlying assumption that by acquiring that asset and taking on new debt, you are going to add to your overall capacity. Okay. So if we were to buy the neighbor's pasture, for example, and say it was my pasture out the window from the last 3 years, and it had been terribly overgrazed by horses during the drought, you're probably not going to see much return from that pasture in the first year. But if you choose to manage it better than I have managed it, you will probably see an increase in your total capacity, which will help you service the debt in the future. The problem is sometimes it doesn't service the debt for the first payment. And that's what we've got to make sure we have enough cushion, if you will, to absorb. Let me show you a quick, before we get to why, think about the why question. We'll come back to that. Okay, quickly, we are looking at, this is, all right, our P&L. I want to show you. So this is, again, the squish down P&L. We have, this is the line that is net operating income. If you'll notice, we have income. We have direct costs or cost of goods sold, which gives us gross profit. And then we subtract our overheads from that number. So that's our total expenses, and we come up with the difference. So 260, 666 minus 201 is about $60,000. We've again done it for both years. We have pretty dramatic differences between these two ranches, or this ranch in those 2 years. Now we compare that number not just to our balance sheet, but we are looking at our long-term liabilities here. Okay. And we are going to look at what are the payments on those long-term liabilities. Now, there are a couple ways we can do this. You can do a simple estimate. Oftentimes, if you use about 8% of your long-term liabilities, you're going to get the payments fairly close enough for rough math. Barring that, you can actually go and add up all of the individual payments. That's a much better idea. In this particular case, we have about $81,000 worth of payments on an annual basis, because we have, some cow debt, we have some car debt, and we have some land debt here that totals, a little over $1 million. That is what we have to cover. When we look at the P&L, I'm going to show you the 2-year P&L and the 2-year balance sheet. I've tried to lump this onto one sheet. I don't necessarily try to read the numbers, but what I want to show you is that in this case, which is this one over here, this is 22, we had $59,000 in net operating income and $81,000 in debt payments. That's a problem. That's a debt coverage ratio below 1, which means that in this particular year, we did not make enough money to pay off our debts. So generally what has to happen is we borrow from somewhere, or we steal from somewhere, not literally, but we steal from some other part of our business, right? So that we can make this payment. In this particular case, the year before, you'll notice they had a $254,000 net income with an $81,000 payment, about the same payment, right? That's a much better debt coverage ratio. That is 3. 3 is above our 1.5 to 2 minimum threshold. Now, in this particular case, and when we look at debt ratio, we kind of need to do some averaging across years. In any particular year, we don't want to be below 1.5, but you might be able to imagine that because of the 21 that these people had, 22 was doable because they had some extra money in their savings account. When we have excess here, we want to make sure that we're thinking a bit long-term. We want to make sure that we're not, spiking one year and troughing the next year, and that 1.5 number can be a multi-year average. I prefer for that 1.5 to be a minimum, that we never actually go below that. But stuff happens. So sometimes we do. Where we don't want to, when we see cases where this is a persistent problem, the the land is dragging, oftentimes it's the land that is dragging you down. Your long-term debt is not allowing you to operate your business in a way that allows you to be persistently profitable. If you are in this type of situation regularly, you kind of need to get out. One of the reasons why I start with working capital and debt service at the beginning of this is because if these are like, this is suffocating. Now, long-term debt is a little different because most of the time we pay it once a year. So this is you fighting with your wife and not sleeping at night for, let's say, 60 days as opposed to 360 like working capital. But this has mortal consequences, right? Not being able to pay your operating loan is bad, but you have a bit of a backstop. Not being able to pay your mortgage, it's a lot harder to backstop that. I don't want to backstop my operating note with long-term debt, but it is possible and it might get me through a problem. If I get behind on my mortgage, there are not that many good options to get myself caught back up again. There was something else I was going to talk about here and I can't remember what it is, but let's go to the next slide. So again, I think we've talked a little about the why of debt coverage ratio. Anybody else have any thoughts on why that is so important? And more importantly, why knowing what your number is important?
John, I'm going to take it back a little bit to burn rate. I know
You
when
bet.
we were doing kind of our prep work ahead of these, you all had some pretty strong thoughts on household expenses and that you can really blow up a burn rate by paying for some things that people don't realize they're paying for from the rent. So talk about that a little bit.
Well, there are two issues there, I think, if I understood some of that conversation correctly. The first one is a very clear delineation between the ranch and family. And those often, it's easy for those to get muddled, especially if you're a Schedule F filer, filing only under your name. If you're an LLC or a C Corp or an S Corp, the lines, legally need to be more clear. We advocate strongly for knowing what the number is. And so we argue with people, or I'd say argue, we talk with people about actually paying themselves a wage. And it doesn't have to be a real wage. I'm going to say wage in air quotes because it's not payroll necessarily like we think of from a tax standpoint, but allocating a certain amount of money to their family living expenses per year and then just living on that. So what I heard from one of the presentations was this problem of, sort of always dipping off the ranch credit card and then saying, oh, well, that's just owner expense or owner draw. Technically, that is correct, but it tends to lead to very bad habits. If you say my family is going to live on $5,000 a month or $10,000 a month or whatever the number is, then that gives you kind of a break, right? When your checking account is low, you tend to slow down how much you spend. The ranch checking account, there's always a line of credit. It's always kind of everything mished together. And so it just gets very messy. It's a great question. It's a persistent problem. We see a huge behavioral change most of the time once people begin paying themselves a wage. And then the other thing is, for most people, it costs more to live than they think. Kansas Farm Management, who does a lot of research on farms and ranches and their accounting, they figure the average living expense, cost of living for a family is much closer to $100,000 than anybody thinks. Now, if you're living in ranch housing, if you're driving a ranch vehicle, if you have health insurance, there are a bunch of things that chip away from that. But if you imagine that family living expenses, we've got 3 kids. If you imagine that number is somewhere in the $80,000 to $100,000 a year in total, you're not very far off most of the time. A lot of times we're tempted to pay ourselves $2,000 a month. That doesn't usually work. Does that sort of address that?
Yeah, absolutely. And that's something that can really put that burn rate up higher without you realizing where it's going to.
That's exactly right. And especially if you leave it uncontrolled, it can leave it very unpredictable. The discussion, again, the part that I heard, and I believe it was in this presentation, it's possible it was in another one, but it was this idea that, again, you set it and you leave it there. And then you see how you both get by. And if you're a growing business, if you're young in this deal, if you're not quite to where you want to be, I don't have any problem with leaving money in the business to allow it to continue to grow. I want to be a little careful about how I do that, depending on how everything's tied together. But reinvesting in the business is not a bad thing as long as it's getting you to the point where ultimately the business carries you, not you carrying the business for decades. But shall we move on? We good?
Yep.
All right. Love it. Okay, let's talk about gross profit or gross margin. This is one that turns out to be very important. And Haley, what is our end time today? I should have asked you that at the beginning.
So we would love to be wrapped up by, 8:35, 8:40, something like that.
Okay,
with questions.
Good. Yep, that'll work. All right. Gross profit or gross margin, it is, as it is sometimes called. It is literally the gross product, which I'm going to talk about in a minute, minus the direct costs. Now, in QuickBooks, we're going to see cost of goods sold. Cost of goods sold has a legal definition in the tax code. I am not using it that way. I am using cost of goods sold because of the behavior of the software to create direct costs. Gross product is the total economic value of whatever we produce. So if I grow a really nice crop of heifers, and I don't choose to sell them, they are reflected in the gross product, but they don't necessarily show up as cash in my bank account. Does that make sense? Okay, so to get to that number where we include the total economic value, we have to do a few adjustments to just sales and purchases. We have to add a closing inventory number, and we have to add an opening inventory number. And to calculate the gross product, we simply add the closing inventory plus all of our sales or revenue, if you will. And then we add and subtract, depending on how they go, intercompany transfers. We're going to come back to that in a minute. So if I, for example, have a stocker enterprise and a cow-calf enterprise, I may sell the calves to myself, if you will, to run in the stocker enterprise. We then subtract any livestock or crop purchases out of this. This does not include feed. This is crops that we deal in, basically. And then we subtract the opening inventory. If we come up with that number, we can divide that number by the total number of animals or the total number of acres to come up with what is a correct gross margin. The gross profit works kind of at the enterprise or business level. The gross margin is, per acre, per cow, per stocker, however you want to do that. We have a few targets here that we're going to talk about in a minute, but I want to go through the demo of how you calculate this and talk a little more about why it's important. Again, I've gone to this same P&L. Yeah, it's the same P&L. I have a few different ones that we're going to look at here. Same P&L where I have expanded it. You can see it's expanded out a little bit so that we can see this trading account, which is how we calculate our gross product. And then I have the cost of goods sold or the direct costs expanded out so that we can see the gross profit. We're going to blow this up just a little bit, get closer so we can see what the numbers are. And I'm going to deal just in the total column to start. We have a beginning inventory, which is here as a negative number. Again, a real accountant will tell you that a tax preparer will tell you we're doing this wrong, and they're correct. We also have livestock purchases. Livestock purchases, depending on the enterprise, are generally a cost of goods sold. So we've also done that wrong. Pay no mind. Just run with me here for a little bit. We then have our livestock sales. We have transfers, which in the total case is a net of zero because we transferred out of one enterprise into other enterprises and then, put them out and then put them back in. So it nets out to zero. Doesn't affect tax at all. No taxable transaction. And then we have an ending inventory. We compare the absolute value or the value without the negative sign in our beginning inventory of the opening and closing inventory. What we almost find is that in every year, we do not run the same number of cows. There are operations that run 300 cows a year, every year, year in and year. But take the last few years as an example. We destocked because of drought on the northern plains and in the northern mountains. And we are currently restocking because many of us are getting rain again. The prices at the sale barn pretty clearly reflect that. I watched some pears sell the other day for $3,300 in Torrington. I was comfortably buying pears a year ago for $1,200. About a week after I bought them, South Dakota went crazy and pears went up to $2,000, right? There's a lot of volatility there. But we see the general pattern happening. What I want to do, where tax and our system diverge, is that taxes don't care if you sell a cow or if you sell a steer calf. It's money in to the business. There is a little bit of distinction, but maybe not as much as there should be. If you are in a drought situation and you are selling off the factory, I am not going to give you credit for that. Does that make sense? If you're cutting into the cow herd and reducing the potential for future production, I am going to penalize you for that. And that's what comparing our opening and closing inventory value does. If I have a huge inventory value at the beginning and a small one at the end, I might feel like I made $1 million, but I probably didn't. I just changed it around. We've all heard the joke about how do you make a small fortune in ranching? You start with a large one. This is our metric that keeps us from doing that, or at least shows us if we are doing that, and might show any other family members, investors, that sort of thing in our operation, what's going on. The ending inventory is a positive number. That's the number I finish with. The beginning number is a negative number, the way we calculate it. We then add up our direct costs. I mentioned this before. Direct costs are the things that change with the number of animals. So think about brand inspections as an easy example. I pay by the head. Think about vaccine, I pay by the head. Think about feed, I pay by the head. Freight, generally pay by the head or by the pound. My fuel bill in my pickup does not change. That is not a direct cost based on the number of animals I own. You can argue that your BLM bill changes, but or a grazing bill changes on the number. We can debate that later. But generally, direct costs are those things that are actually attributable to the animal. When we come up with that subtraction, we come up with a number that allows us to do two things. It allows us to calculate an efficiency. So how much money do I collect, as an example? So I received checks for $450,000, right? I made some trades within my organization. I grew my herd, okay? And then how much of it do we actually keep in terms of economic value? And that's a very important distinction. So there's the amount of money that we handle, and there's the amount of money that we keep. Our gross profit is the amount of money that is left over to pay all of our overheads, to pay taxes, to service debt, and to create a real business profit. Gross profit is like an intermediate profit. So it's unfortunate they use the word profit here. Accountants are famous for doing a terrible job naming things, but this is sort of an intermediate level of profit. If you recall, I showed you this P&L where we have the gross profit about a third of the way down or halfway down in our P&L. And then after that come all of our other expenses, right? Labor and equipment, land, all that. So I don't want you to think this is the profit, but it does give you a measure of efficiency. And what it really allows us to do, well, let me break this into a few different pieces. Shows us the economic value of our production. That's the gross product. So here, even though we sold $450,000 worth, that's what we actually took in checks, we spent $365,000, but the gross product is not simply the difference of those, which let's say is $85,000, because we increased our herd size by $250,000. So we give ourselves credit for that. That is not money you can pay your bills with, but it does give an indicator of your ability to be profitable in the future. When we do that, we also have the ability, okay, we talked about it, correcting for destocking and restocking. Oh, it all gives us the ability to look at asset turnover. Maybe I have a slide for this. Nope. I can look at my gross product as a function of my beginning inventory value. And I think I'm going to look at that in a different example. But if that kind of makes sense, how the assets that we own, how much cash are they actually producing? How much value are they producing? That measure of economic efficiency becomes pretty important as our operations grow. All right, gross product. Let's go to gross profit. Here we go. Like I said, shows us what we have to pay our overheads, to pay taxes, to service debt, and to create business profit. We can pair it with a number of other tools to help us make marketing decisions going into a drought and coming out of a drought. So when you go into a drought, how do you decide what you should sell or what you should buy back? Those are pretty important distinctions, or pretty important decisions, excuse me. It allows us to make very simple comparisons between enterprises. and it gives us this measure of efficiency. So we have a certain amount of money in this business. We have multiple enterprises, we'll call them, or classes in our accounting software. We run a cow-calf operation, we run a stocker operation, and then we run a replacement heifer operation. What I want to know, we have a certain amount of money tied up in these different operations. Long-term, if we are going to manage for profit, we want to allocate our money to the things that are profitable. I've got $575,000 tied up in a cow-calf herd. Okay, that is literally, that's the value of the herd. Okay, and that may be the amount of money more or less that I have in there. That $575,000 generated $232,000 in economic activity. It generated, as we recall, $315,000 in sales, and then another $215 in, additional animals that went out to the stocker enterprise, partially went out to the stocker enterprise, partially went to the heifer enterprise. If I take there's something called a profit ratio that we look at. We take our gross profit and we divide it by our gross product. So yellow is the gross profit and green is the gross product, or the total of the trading account. We can see that there are differences between these. Now, this particular business doesn't have big differences. The difference between 68 and 76, we're just going to wipe off. These will range from negative numbers to almost 1, some occasionally 1 in the right type of enterprise. I'll just say that these are comparable. Okay, my resources are working and producing money that I can use to pay my overheads, pay taxes, service debt, create profit. This replacement heifer enterprise, partially by definition at the stage that this is working, is not doing that. Now, in the narrative that goes with this example, it's very fraught with all kinds of troubles, et cetera. We're not going to go into that. But what we want to see is that this is a big goose egg right here. What we want to see is that there are big differences. I've got a few other examples that are going to look at that in a little more detail. Okay. Oh, I mentioned the turnover. This spot is in the wrong place. I took an average asset value, which is the average of the opening and the closing. Okay. And I divided by the gross product. That gives us another kind of measure of efficiency. What is that asset or that money tied up in that asset returning on a gross profit level? We might not spend a lot of time on that. We can come back to that if people have questions. So then we're going to look at a different enterprise. We are often told in agriculture that diversification is the key to success. And I like to respond that diversification is for people who don't know what to do. As I mentioned, we usually have 3 to 5 enterprises. There are thoroughbreds usually, and there are dogs. We want to run the thoroughbred. We want to cut the throat of the dog as fast as we can, or at least get it to a shelter or a well-meaning family where it can sleep on their bed, not on ours. We allocate resources to get our best return, and we recognize that this is variable year by year and season by season. And that whole context thing that I mentioned before, we want to pay attention to that. If I am somebody that only wants to run cows and calves, then that's one type of business and one mentality. If I'm willing to run cows and calves or stockers or breed replacement heifers or do some custom grazing, I have some other opportunities. In this particular ranch, this is a real life ranch. We have, 1, 2, 3, 4, 5, 6 different enterprises. This general ranch is a bit of an overhead category, kind of ignore it for now. This gives the summary of their P&L all collapsed down. I'm going to show you the detail in a minute. Well, no, I guess I'm not going to show you the detail. What I'm going to show you is that you can pretty quickly see that there are massive differences between these enterprises. This gentleman had to make some serious changes to his stocker enterprise because it wasn't even generating a gross profit, right? This was taking money away from his ability to pay his overheads, pay taxes, service debt, and create profit. On the other hand, his custom feeding, he has a pretty substantial grow yard, was generating some pretty nice free cash. This guy had run pigs for a very long time. What's fascinating to me about the pig business is that, and the feedlot business got a little the same in 22. Feed costs got very, very high. Prices in the pig world didn't really go up at all. And so his gross margin went from a number very good to fairly paltry $16,000, which if you've tied up, $100,000 in feed, doesn't, we talked about not keeping much, and that became the problem with the pig enterprise. Anyway, does some other stuff, this dog enterprise. We want to look at these in two ways. We want to look at the ratios, and we want to look at the actual dollar amounts. In this business, the custom grazing and feeding business is the elephant in the room. It's what produces the majority of the cash. I don't love the gross margin ratio. I'd like that to be closer to 50%. But the dollars sort of make up for it, if you will. And this guy has been able to be profitable. Anytime we see something like this, we have targets here. I think I mentioned that I didn't mention them. We're going to come back to those. They're different for different enterprises. A cow-calf business, I'd like this number to be about 70%. Custom grazing and feeding, I'm willing to take 50%. 35 even to 50% is acceptable. 50 is good. Stockers, I want this number 70 plus. The pigs, I want that number 70 plus. The feed sales, I don't know much about this, but the 50% or better ought to be where we're at. And this dog thing, we'd like this to be over 50%. But I'm focused on the big dollar numbers because that's where we can move the needle the most with a little bit of leverage. This gentleman decided not to run pigs anymore. His kids literally went to college last year. They had been doing all of the work. It was a great way to keep his kids busy and off the streets kind of thing. The kids went to college. He realized he hated feeding pigs, doesn't do it anymore. And has since reinvested that money. He's restructured his stocker business, restructured his custom grazing business, restructured his cows so that each of those is producing a much more significant profit. Got out of the pig business and has made a pretty dramatic change in his operation. I didn't touch on them here. Let me go back to this slide right here. We have a few different targets based on the type of business. Most importantly, we need to generate enough dollars of gross profit to pay our overheads, to pay our taxes, to service debt, and generate profit. If you are an investor in cattle, running them entirely with someone else. So, for example, some of you may know who Wally Olson is. He buys cattle and then puts them out with someone else. Effectively, he is looking for a 25% return. That number can be lower because at the gross profit level, all of the costs are direct costs. If you are a feedlot or a feed intensive operation, so this is, cattle feeding, this is pig feeding, this is chicken feeding. We expect a number down around 50% to be good. Again, 35 to 50 is acceptable. When we're down at the 35 end, we're generally not keeping enough to really make it worth the time. And then if we have cattle like on an extensive ranch, grazing, that sort of thing that we own, we expect that to be about 70% or better. If you are feeding 5 months of the year at $240 hay like we were last year, you're not hitting that target, I would be willing to guarantee. We had people that hit a number much closer to 80% there. That means of what they have, of the economic activity they generate, 80% of it is available to the business to pay bills and generate profit. And then if you're in something like a custom grazing business, we don't really have any direct costs, right? Everything's a pass through. And so we expect a 98% or better, 100% in theory. We never quite hit that, but we have a target that's very, very high there. All right, I'm going to jump back ahead here with that in mind. Okay, I've got just a couple of summary demos that we look at that are going to cover some things that we didn't have time to cover today. But they give you an idea of the way we think about things. And so, I use a green, red, yellow, or green, yellow, red type scheme for green is good, yellow is caution, red is bad, right? This is a real example. This guy has a ewe lamb enterprise that generates a 92% gross margin ratio. Quite good. He doesn't spend a lot of time feeding. He is very good at marketing. He spends a lot of time, effort, and energy. He doesn't take his lambs to the sale. He markets them nationwide. He has a great product. People like them and they pay a premium for them. And he is happy to collect that. He also feeds lambs. Mostly grower lambs, if you will. So buys weaner lambs, grows them up. He does a pretty good job at that, 73%. This ram enterprise, and kind of ignore that. We have there's some data not included there, basically. And then he does some custom grazing. Custom grazing, just like we expect, all the costs are passed through. So doesn't do much, and then he raises some guard dogs, LGDs, that he sells. Okay, so we're all green in our gross margin ratios. We look at asset turnover. We really didn't get into this today. I don't want to go too far with this. Custom grazing asset turnover is a meaningless number, so pay no mind to that. The dog thing, it also is kind of wacky. We don't need to worry about that. But essentially, he has an average inventory value in his ewe lamb enterprise that is $61,000, and he is generating almost $300,000 off of that. This is a pretty, I'm not going to say it's completely exceptional because we see a number of these, but this is a fantastic asset turnover ratio. His lamb ratio, compared to almost 500% doesn't look nearly as good. But again, if you can spend $1 and collect $1.65, that's usually a pretty good situation. We look at, I mentioned some of our structure things, and you've probably seen our overhead categories are generally grouped under admin, labor, land, and PPE. We take the gross profit in dollars and divide by each of the categories. So our total admin spending, and we come up with a dollars of gross profit per dollar spent. I don't pay much attention to the labor or the admin number here. I pay a lot of attention to the labor number. We see a range in labor here that is on the order of, $2 up to $40. What this means is that in this business, for every dollar he spends on labor, he generates $5 in gross profit. Now, gross profit, remember, is gross product minus direct costs. So that's a pretty good number. This is okay. We like to see this over $8 if we can. Similar on land, a little more variable, depends if you lease or own. There are a few criteria we use there, but in his case, pretty good. And then equipment. He doesn't run a lot of equipment. He lives in a fairly mild area. He spends 30 days a year feeding, and really is kind of a pretty bare bones from the equipment standpoint. We run through his working capital right here. We have his current assets minus his current liabilities. He has 76 days of working capital, which is okay, not great. We're trying to get up over the 120 mark. We have a debt coverage ratio of almost 5, which is very solid. And this number is pretty comfortable year over year. And then we have some return on equity. He has a goofy equity number. I don't really want to get into that right now. But these are some of the summary numbers at the top level that we look at. We also use this little spreadsheet as kind of a summary. We use something called the DuPont model. I'm not going to walk through this right now. But again, essentially, it gives us an idea of how our debt is performing relative to our business. So are we borrowing money and generating new income, or are we borrowing money and generating new expense? And then let's get to the final. We'll wrap up here. I am a firm believer, having done this for a while, that profit is a choice. There is a whole host of people that will tell you you can't make a profit, you can't be profitable, it's hard to be profitable, etc. I just totally disagree with that. If you're going to be a successful multi-generational business owner, you have to be profitable. You can mine the deal for periods of time, but that is not going to work. People always say, well, we're not in for the money, we're in it for the lifestyle. Being broke and not being able to pay my bills is not a lifestyle I'm that interested in. And I really am interested in teaching my children to be, sort of creative, powerful forces in the world who go out and make changes and tell people like our current, we'll just say people in charge, that they're wrong and prove them wrong. We work with clients all over the country, and I don't say that to brag, but we see huge variability. Profitability is very variable. There are no trends based on geography. Action is what matters. And we have customers that are buying their neighbors' places with the proceeds from agricultural operations. This is not oil money, or this is not mom and dad's money coming in. This is not refinancing, inherited equity, that sort of thing. They are running the operation in such a way and generating enough cash to carry additional debt. And we have customers who might be bankrupt next year. Again, 3 years of drought, overpaying for hay for that long. And there are people that are not getting rain even now. That's put a lot of people in a very bad position. Managing debt is probably the most common thing that actually causes, bankruptcy. It's not necessarily the expenses. It's oftentimes terming out short-term debt and doing that multiple times. There's a huge difference, as I mentioned earlier, between what is possible and what is average. The average in our industry is not that good for profitability. We have all kinds of excuses, but when I see people that consistently generate, pretty significant 20+% returns. And they do it all over the country, and they do it in cow-calf, and they do it in stockers, and they do it in lambs, and they do it in, goats. That tells me that it is possible. And if I am not achieving at that level, then that means that I need to step it up. The example I want to set for my kids is that if I am underperforming, I'm going to take responsibility for it, and I'm going to change it. And I think that is an attitude that has been very common in our industry and has gotten diluted. And I really worry about our future as a country because we've diluted that. And I worry about our future as an industry because we have allowed that to come into our culture also. So with that, I am very thankful to you guys for having me. Sorry, I'm a couple minutes long there, Haley. I thought I was going to be about 5 minutes shorter. Just a fun reminder that the customers we work with all over the country, like I say, they often push us and challenge us to be better than we currently are. This is an evolving system. As we learn more, we try to do more. We have a website that has most of the background information that I have given here in this presentation on it. So our chart of accounts template, our P&L templates, balance sheet templates, some of those things. There is a lot of other stuff we do. I've chosen to focus on the P&L and the balance sheet because it's familiar to most people, and it really probably covers 75% of what we really want to talk about. So with that, I'm more than happy to take questions, comments, whatever.
John, you said diversification is for people who don't know what they want to do. I feel very called out.
I don't say that to pick on anybody. There's a huge movement, and it's become very fashionable. Joel Salatin is kind of the spearhead of this. You should run chickens and turkeys and goats and pigs and bears and ostriches. And I watch people get into that, and they become run ragged, and they're not being good at any of them, and it causes them to fail. We work with a lot of people who get to that point and then decide they want to go back the other way. So, again, if you like doing all that stuff, that's fantastic. But oftentimes it creates a lot of busyness.
So yeah, if anybody does have questions for John, go ahead and drop them into our chat. This is a very basic thing, but as we were starting this 3-part webinar series, we were hearing from a lot of people that they were just struggling with forcing themselves to have that sit down, whether it's one day a week, one day a month, to look at the books. It's easy to push off when you've got other stuff to do, especially as the weather, if you haven't been getting the rain, has been, good enough to get out and do things outside. So,
we still do things outside. We just have mold growing on our feet. Yeah.
But yeah, if you could kind of just, I guess, reiterate that this is every bit as important as those other parts of what you're doing.
I totally agree. And I can't tell you, almost everyone I talk to, they know they should be having what we call what-be meetings, working on the business meetings, right? We need to have sort of daily and weekly meetings to know what to do and who's got to use the tractor and who's got to use the, but we need to be having discussions where we talk about the business from kind of a 30,000 and 20,000 foot view. It's not uncommon for people to struggle with that. And there are a number of reasons. One, most people don't know how to do it. I don't know about you. I was never trained in how to have a good meeting. Even as a manager for companies, I was not trained in that. I have received some training in that, but it's a skill, and most of us aren't very good at it. As a result of us not being good at it, most of the time we don't produce good results. And so when we don't produce good results, why would you do it? Why continue, right? It seems stupid. So we kind of give up on that. Teaching people how to have good meetings is something we've gotten fairly serious about because it is what matters. And arriving at the meeting with information and then being able to have a quality discussion really makes a big difference.
All right. Again, if you have any questions for John, you can go ahead and drop them into the chat. But John, I think the one thing that I was tossing around in my brain is just, you said a few times that your accountant's not going to like this. Your accountant's not going to like this. So how do we find that balance between professionals to make sure that we're doing this for the right cause?
It's a great question. I think you do it with open communication more than anything. Almost always, if you shove our financial report in front of a tax preparer, they're going to go, "What the?" But as soon as we sit down and discuss it, they go, oh, that makes sense. I understand. And we've created a map for our financial system where, on this line, this is the correspondence to a Schedule F for the various tax forms. Okay, so part of that is just a mapping thing, but more than anything, I think it's open conversation. I am a firm believer in, and I really enjoy participating with ranches that are run by teams, meaning the rancher owns the ranch, but then that rancher has a lawyer that they communicate with on a regular basis. They have a tax preparer they communicate with on a regular basis. They work with us oftentimes. They oftentimes work with a nutritionist, right? We surround ourselves with experts on a, sort of on a fee for time type basis that allows us to have really good information. Even my tax preparer, who loves what I do because we take him organized information, he appreciates the organized information. He says, but that's not how I would do it. And that's fair. We disagree on what the purpose of the bookkeeping is. But we can both function in the same space because we like and respect each other. And that's a huge part. So again, I never mean to insult accountants. I'm trying to be a little bit funny and lighthearted with that when I say that. But there are individuals that are like, this is ridiculous. You can't do that. I had somebody recently tell me that there's no difference between tax depreciation and book depreciation. It's like, that's the most ridiculous thing I've ever heard. Like, whatever, I guess we see the world differently. That's fine. So yeah, I think there's a big difference. Now, one of the things I think it might've been the second presentation we were talking about tax depreciation, or was that the first one?
Probably the second.
Okay, so again, there's a huge difference between tax depreciation and a tax-oriented balance sheet and what we use, which is a fair market balance sheet. We want to be able to get from one to the other, right? It doesn't have to be hard if you do the work correctly, but we have to be able to demonstrate where we're at for taxes, and then when we go to the bank, where we're at with our collection of assets. So given the wonderful tax laws that we have, I'm a huge fan of aggressive depreciation if you need it. We can go and buy, let's say, $150,000 tractor, and within a very short time have it show as something not very valuable on a tax-oriented balance sheet. That doesn't help us when we go to the bank and need to borrow money. And so we try to keep things on our working balance sheet so that it's more or less ready to go to the bank, which means that it is fair market value. It's not an exaggerated value, but it's not unnecessarily depreciated because of the law.
Well, John, I introduced you to Angel DeVries, our executive director, before we went on, and I forgot to tell you that she is an accountant. So
yeah, I think I knew that.
Angel has a question.
So, Angel, do you want to comment on that at all?
No, you're totally right. Yeah, the depreciation that you get for tax purposes is different than the depreciation that's generally applied to your business or what you might see. I mean, how many people have tractors from the 1940s still sitting on their property somewhere? I mean, it's fully depreciated. Maybe it's not being used, or maybe you have tractors that are still that old and are being used. Tax purposes are just different. They have to systemize it for your tax return. But John, I have a question just because I've been really interested in managerial accounting a little bit more for ranches, obviously. And how, for someone who this idea of enterprise analysis and calculating all these ratios, and this is brand new to them, they have not yet got their hands on this. Give them an idea of about how long they should expect to start to analyze and go through their books. And then once they've done that, once they've got like their first clean sweep of getting a handle on their finances, how often do you want them to revisit those ratios and revisit those analyses? I mean, we talking monthly? Are we talking quarterly, semi-annual, annual? What should people be expecting once they get a grasp of these ratios and analysis?
Great question. I'm going to try to start with the last part of that first. Is that all right? And then you can remind me of the first part when I forget halfway through. Okay, so there are a couple of different reasons we choose different tempos. With most of our customers, we tend to work on a monthly basis. And the reason being is, and I'll just say it depends. So we have if it's a straight cow-calf deal, there's a point in the year, for example, when the die is kind of cast. Right now is a perfect example, right? We kind of have a good idea of how much grass we're going to have to get us through to weaning. We kind of know where the market's going to be. We've made some breeding decisions. We've made some numbers decisions. We're just going to roll forward with it. So we might, because we do it, we might do it monthly just to kind of keep on top of things. But really, we're looking more quarterly, semi-annually in a pretty straight cow-calf type enterprise. Same with ewes and lambs. If we're not making big midsummer moves, right, again, we're kind of already committed. If we are working with a feedlot operator who is actively trading cattle in and out every week, the tempo will be much, much faster. And the other things that matter is how aggressive are you willing to be with your inventory? I am strongly against adjusting the balance sheet value of things that you are not willing to be a trader in or to deal in. So, when your land value goes up by however much, we don't make necessarily any changes on the balance sheet. But if I'm dealing with somebody that is willing to sell stocker cattle, so for example, a feed yard that trades in and out of stocker cattle, we might be adjusting that inventory value every week or every month. And again, looking at how that reflects in the business. There are much longer cycle businesses. We try not to get to the level of, twice a year, but it is possible. And if you're doing it yourself, that's probably pretty manageable, right? But if you're in a seed stock deal with a 3-year, 2-year, 3-year life cycle, it can be significantly less. So I don't know if that answers your question. Monthly for us has a lot of great advantages. Banks work on kind of a monthly tempo. Monthly for me is not too frequent and not too far apart. So if you ask me about a receipt from 7-Eleven from 6 months ago, I have no clue. If you ask me about a receipt from 2 weeks ago, pretty good chance I might be able, my wife and I can talk about it and we can probably come up with what it is. So one of the reasons I love monthly is because you're kind of within the realm of we can remember. Now, remember, I have 3 small children, so there are periodically times where I don't sleep more than about 4 hours a night. I can't remember what yesterday was, but it's a probability thing. Now, how do we learn about how to do this for ourselves? There are a couple of great tools at our disposal. I am a huge advocate for the Ranching for Profit School. I took that school in the early 2000s. I am not going to tell you that school is perfect, but I absolutely love it because it gives people some really good tools. And the tools are, one of the tools that they offer on their website is a whole series of spreadsheets that allows people to do some of what we've done, but without doing it in QuickBooks, right? For most people, using Excel is a lot easier than using any type of accounting software. Accounting software is kind of its own thing. You have to, QuickBooks sells itself as this everyman's accounting software. You're a real accountant. You've seen, I'm sure, plenty of horror stories. We see plenty of horror stories. We had a slogan for a while because we had a lot of people that were like, oh, I'm kind of embarrassed for you to look at our books. And it's like, oh, don't worry, we've seen worse. Like there's no way. There's a lot of room for that to go bad. So that's one place. The other one, it goes back a little to Haley's question about meetings. There are times when we can do these in all kinds of great detail with great specificity, but there are also times when we just need to sit down with a yellow pad and draw a few things out. And many of us suffer from blank paper syndrome, right? We don't know where to start. But I think you just have to pick a place and start. And I love to start at the end because the end gives me an idea of where we're going. So I know, for example, that we are going to be selling feeder cattle in August. So I can start there. I have a rough idea of what the price is going to be. I could even lock in an LRP. Once I have that point, so let's just say that happens on the 25th of August, they're going to ship. So now I can guess what the sale price is. I can guess what the commission is, and then I can back up and figure out what the grass costs, the feed costs, the supplement costs, the fuel costs, all those things are. We try to stay really focused on the big numbers and not get too mired down in the details. Angel, your job is literally to be mired in the details, right? You have to make these things work to the penny, right? So do we, right? When we do a bank reconciliation, it's not good enough for me. This would be my way of reconciling. That's close enough. We're good. That doesn't work, right? But for most people figuring out these different enterprises, that is good enough. And many times, like in that example I showed you with the guy with the pigs and the dogs and the cows and the stockers and the custom grazing, the differences are so stark that they present themselves. You don't, if you're off by 20% in any one of those, you're probably still going to come to roughly the right conclusion. And I think if you are willing to start down that process and at least try, you are so far ahead of anybody else. And then, of course, it's the principle of practice. You and I do this every day, right? You can probably do this in your sleep. I can do it when my kid's been up all night and I've had 4 hours of sleep. For the average person that tries to do it once a year or twice a year, it just doesn't work. Like, you have to practice. And one of the great things at the Ranching for Profit School, the opportunity it gives you, is they have a bunch of sample stuff and you can just go through and practice them. Now, most of us hate doing math in our spare time, right? What kind of nerd do you have to be to like say, oh, I'm going to sit down and work through some Excel spreadsheets on a Saturday afternoon because it's raining? Like, that's the last thing most of us want to do. But if you want to get good at it, that's kind of the skill. The other side to it, again, I alluded to, surround yourself with a good team. I have lots of clients that aren't that good at accounting and they know how to produce a lot of value. So they could spend 3 times the amount of time it takes us to do their bookkeeping, or they could pay us to do their bookkeeping and go generate a lot more money with that same amount of time. You can learn how to do this. And I'm not against people learning how to do it, but I am really against people doing things that they're kind of not good at when they are giving up opportunities to do much better things. Our individual time is the ultimate opportunity cost, right? I can pay other people to feed my cows. I can pay other people to change the tire on my pickup. I can pay other people to do my bookkeeping. I can't pay other people to lead my business. And that, if I'm doing it correctly, produces the most value. So if you have clients that are working with you, I would suggest that it would be best if they got with you and figured out how you can do this for them instead of them figuring out how to do it.
Oh, no, I pay an accountant actually to do.
Yeah, perfect.
To do
so,
our tax
because your value is in doing the tax, I presume.
Well, they do the tax return and we do the enterprise analysis, but
okay, very good. All right.
Tax software is too expensive for me to jump into that.
Yeah, that's its own whole thing. I still marvel at tax preparers who will do it for $200. That's an amazing fee to me. But so I'm curious, Angel, what your thoughts are. How many other things do we do that are incorrect that we talked about here today? Our cost of goods sold is all messed up. I understand that.
No, I get your systemizing and why you put it there. It makes sense to me, but also, like I said, we've been digging into that enterprise analysis a little bit more. And also, when you were talking about the asset side, I don't know how many people here tonight have sat down with their banker and gone through their like loan renewals very detailed, or how much your banker asks, but our banker asks for a lot of detail on that. So every year we're calculating how much is our hay pile, how much is, how many calves are on the ground. And so we do that rather frequently. So it all makes sense in that sense, but those aren't like, you're not giving your hay valuation numbers to your tax accountant because it doesn't mean anything to them. So
correct.
Anyways, no, it all makes sense to me. It's all very good information, John. Thank you.
Cool. Thank you, Angela. I appreciate that.
All right. Well, it looks like everybody's pretty quiet in the chat. So, John, thank you so much for joining us tonight. And
you are very welcome.
Website, your contact information, all of that with our follow-up emails. So with that, for folks that are in the audience there, I do want to remind you of our YouTube channel. Again, we'll follow up with an email that will give you that link to our YouTube channel where you can go ahead and watch all 3 of these webinars again, or for the first time if you haven't done so. And then also, as part of that, we are going to have a follow-up survey. We want to know how you think that we did, because it's the first time that we've run this event. We do have plans to expand on it, possibly with an in-person portion as well. So we want to know what resonated with you so that we can make sure to continue to put our efforts in the right direction with that. So thank you everybody for joining us this evening and for joining us for all 3 sessions during this busy summer season.